In 2025, Japan recorded the lowest number of births in its history since the government started counting in 1899. Deaths outnumbered births by almost 1 million people in a single year. And that's not even the scariest number in this story. Japan's government now owes more than double what its entire economy produces in a year. And for 30 years, this country has been the world's live experiment in what happens when a rich economy stops growing. We've mostly treated it as a curiosity. Interesting, sure, not our problem. But right now, several of the exact same ingredients, the debt, the aging population, and the asset bubble, are quietly stacking up somewhere much closer to home. Here's how it started. By the end of the 1980s, Japanese real estate and stocks had gone almost vertical. At the peak, the Tokyo stock market was worth close to the entire U.S. stock market combined. Land in Tokyo, by some estimates, was worth more than the entire state of California. Then, starting in late 1989, it broke. The Nikkei lost well over half its value in under 3 years. Property values fell for over a decade. And the growth that had made Japan the envy of the world simply stopped. Economists call what followed the lost decade, except it kept not ending. First it became the lost 2 decades. Now people just call it the lost 3 decades because deflation, weak wages, and a debt pile that never stopped growing simply became the new normal. Regulators were slow to force banks to admit their bad loans. A tax hike in 1997 choked off a recovery that was just getting started. And a culture of endlessly propping up unprofitable companies, banks kept lending to firms that couldn't even cover their own interest payments, meant the weakest parts of the economy never really got cleared out. Economists have a word for those firms: zombie companies. And as of the most recent data, around 1 in every 7 companies in Japan fits that description. So that's the past. Here's the uncomfortable part. The reasons this dragged on for 30 years aren't unique to Japan. A few of them are showing up right now in some of the world's largest economies, including ours. 3 things drove Japan's trap, and all 3 have a version playing out elsewhere today. 1. Debt. Japan spent 2024 doing something no other major economy had done in years. It finally raised interest rates above 0. But with debt this large, even small rate hikes hurt. Japan's own finance ministry projects that interest payments on its debt will more than double over the next decade. Meanwhile, U.S. federal debt is following a similar long-term path, driven largely by an aging population needing more from Social Security and Medicare than the next generation is paying in. 2. Demographics. Japan's population has been shrinking since 2008, but the U.S. isn't immune either. The American fertility rate hit a record low in 2025 at just 1.57 births per woman, edging toward what economists call an ultra-low fertility trap, where the decline starts feeding on itself. 3. Asset concentration. Japan's crash came from a stock and property bubble built on cheap money and unchecked optimism. Today, some of Wall Street's own analysts are drawing a direct line between the hype around AI stocks and the mood in Tokyo right before 1989. Now, to be fair to the people who'd push back on this isn't a prediction that the U.S. is about to relive Japan's exact story. There are real differences. The Federal Reserve raised rates aggressively to fight inflation. The Bank of Japan didn't. The U.S. still takes in far more immigrants than Japan, which softens the demographic hit. And today's AI investment boom is mostly funded by companies with enormous cash reserves, not the highly leveraged speculation that fueled Japan's property mania. The mechanisms rhyme. The story isn't identical. And that distinction matters. High debt and an aging population don't automatically mean collapse. Despite everything, Japan still has essentially full employment, some of the best infrastructure on Earth, and a currency the rest of the world still trusts. 30 years of stagnation is a genuine economic failure, but it isn't the same thing as a crash. What Japan actually shows us is something slower and less dramatic, a quiet erosion of growth, wages, and economic flexibility that compounds over decades once debt and demographics begin working against each other. That's the real warning in Japan's story. Not a single crash to fear, but a set of trends that, once locked in, become brutally difficult to reverse. Japan has spent years trying to increase its birth rate. Births kept falling anyway. Debt-fueled stimulus kept the economy limping along without fixing the underlying growth problem. The lesson isn't that the U.S. is about to become Japan. It's that once debt, aging, and asset bubbles start reinforcing each other, the window to change course becomes much narrower than anyone wants to admit. So no, the U.S. isn't Japan in 1989, but it's carrying pieces of the same machine. And Japan spent the last 3 decades proving just how long that machine can keep running before anyone realizes it's actually broken. If you want to know more, like, subscribe, and I'll see you in the next one.